I'm Alan Kenny with REIT.com, and I'm at Georgetown University for the Real Estate Luminary Series. Joining me is Mike Kirby, Chairman and Director of Research with Green Street Advisors. Mike, REIT valuations are pretty strong at the moment. I want you to give me your Goldilocks assessment of the IPO market. Too hot, too cold, just right?
There's almost no example of a really successful IPO in this most recent crop. Now, there's a lot more coming. You have a lot of publicly registered non-traded REITs that need to have a liquidation event, and we expect to see more of those come public. Now, they're not price sensitive, so they will come public, and they will be members of REITdom. Will they, out of the chute, be great members of REITdom? I don't know. I mean, a lot of them have to grow into being as good an operating platform and as good a company as the public companies that now exist. And so, with some seasoning, they can improve their game and they can be upstanding, solid members of the public REIT space, but they usually have some education to do the first few years out of the chute. And then the thing we're most excited about are the real platforms, generally the companies that went private a while back. There's a lot of those, well, several of those at least, still in the queue somewhere, and Archstone is obviously the most famous of the group, and we don't know if they're going to come public. That remains to be seen. If they do, they will be welcomed into the market. There are others of that ilk that went private, and there are also some interesting platforms being built by various private equity shops, particularly Blackstone. So I expect to see some highly credible, larger deals run by management teams that we know and respect that may well represent the first crop of REITs in this IPO wave that will be really successful.
And those IPOs, they're obviously looking to cash in on some of the stronger valuations we're seeing right now. How much room do you think that REITs have left to run?
Well, I think we're in a really nice environment for REIT share prices. We have a recovery in fundamentals in the real estate space. That's certainly not vigorous by any means, but it's not bad. And couple a not bad recovery with the fact that interest rates are just very, very low, and it certainly helps keep pricing up high. The pricing seems a bit rich, certainly relative to stocks. It's hard to explain why REIT multiples are where they are relative to stock multiples, but when I look at what's going on in the bond market, and I look at the yield that REITs throw off, it's quite attractive. And so it depends on what you look at, but if bond yields stay this low, I think REIT prices will certainly stay at least this high. And as always, I think investors should just walk into REITs trying to get diversification as opposed to trying to time the market. And I think a reasonable expectation when you buy REITs is to get a return of, call it 7.5%, 8% on a very long-term holding period, and have them be 5 or 10% of your portfolio rather than time the market.
And Mike, you've been a very big advocate of REITs deleveraging. We saw a lot of that during the financial crisis. How have REITs been able to kind of stick with that? Have they been kept in check?
Well, I think there's three groups of REITs. There's one group of REITs that got it from the get-go, that walked into the financial crisis with really good balance sheets. And those companies have done phenomenally. They've delivered high double-digit total returns over a 10, 15-year period to their shareholders, and they've sort of delivered the promise that REITs have to deliver when they do things well. There's another group of REITs that was over-levered entering the downturn. They had to re-equitize their companies, which, boy, that was painful. And now some of them get it. And so some of them have delevered their companies, and they've basically admitted that what they were doing before was wrong, and that a leverage ratio closer to 30 rather than 50 makes a lot more sense. And kudos. I mean, you can make a mistake once, and that's fine. But those companies that have lowered their leverage ratios from where they were 5 or 6 years ago, we think very highly of them. We think of them in the same bucket as we think of the guys who never got into trouble in the first place. Unfortunately, there's still quite a cadre of old school think out there. And the old school think is that real estate is an asset class that can be levered 55, 50%, 60%, somewhere in that ballpark, without great harm. I think that's foolish. We just witnessed a valuation decline of 40%. That when you're operating a vehicle, it's 50% levered, and the asset values can drop 40% in 6 months. That doesn't strike me as smart. And so when we evaluate those companies, we take that into account, and it's not just us. They trade at big discounts to their peers.
All right. Well, Mike, it's always a pleasure. Thank you very much for joining us.
My pleasure.
And for more on this and other REIT news and analysis, check out REIT.com.